Today we will take a look at Alphabet, Google's parent company, which is currently trading at around $2,400 before its 20-to-1 stock split next week, which will take it to around $120 per share. And if we take a look at the just recent performance, it's up around 11% in the past 5 days. Meanwhile, the year-to-date performance, it's down 17% along with the market, basically. And in the past year, it has been trading in the range of $3,000 all the way down to $2,000. So it's about this 17-18% down, up from its 1 year lows. So in the video, we will take a look at the business's overview. We will take a look at the financials, and at the end, we will do some discounted cash flow analysis on what kind of returns we might expect in the future for Alphabet. Alphabet is typically divided into Google and other bets. The Google part includes their search engine, their cloud platform, YouTube, the Android operating service, Google Chrome, Google Drive, Gmail. Just typically everything you would associate with Google is under their Google brand and under Alphabet. And the other bet companies are usually these kind of moonshot, as they like to call them, companies that they acquire or build, and they hope to eventually develop and grow like they did with Android and YouTube when they acquired them in the past. Current other bet companies include the drone delivery company Wing and autonomous driving company Waymo. But how does Alphabet make money? In 2021, Alphabet made roughly $257 billion in revenue, with over half of it, or 57.8%, coming from Google Search and others. Other Google segments of the company, YouTube Ads, Google Network, Google Other, and Google Cloud, each make up around 7 to 12% of the revenue, and the aforementioned other bets only made up about 0.3% of the total Alphabet revenue. And if we look at where Alphabet's revenue is coming from in the past year of 2021, 46% of it was from the United States, 31% from Europe, Middle East, and Africa, 18% from Asia and Pacific, and 5% other Americas. Now we can jump into some financials and key ratios. So here we have the income statement, the annual income statement for Alphabet for the past 10 years. And what we're looking at here is basically just continuous and consistent growth. And of course, Alphabet and Google have performed extremely well over the past 10 years, but we can take a look at it here. So from 2013, the revenue was around $55 billion. And in the 4-year period from 2013 to 2017, it doubles from 55 to 110. And then over the past 4 years, it doubled again from 110 to 257. So more than roughly doubled there. And if we take a look at it on the graph, it is very consistent revenue growth, and it doesn't seem to be slowing down. And if we take a look at the net income, then we see the same. It's a very consistent growth, and then there's a bit of an off year here, an anomaly year in 2017, but we can see that 2018 continues the trend as if 2017 didn't really have an off year, so there was probably something of an anomaly here. And again, last year, 2021, somewhat of an anomaly where the net income grew from $40 billion to $76 billion. If we would just continue with the compound growth rate from the past 10 years, we would probably be around this $55 billion mark, which we will see later when we do the discounted cash flow analysis, that there is projected to be some stagnation here, at least for 2022, which is normal after a huge year like this. And again, with the earnings per share, we can take a look at the graph here. The same, of course, when the net income goes down, the earnings per share go down in 2017, and again a huge step up here in the last year in 2021. And lastly here, we can maybe take a look at the shares outstanding, and it's been very consistent. They're not really issuing shares anymore. They did for a little bit, but still within like 5% new shares issued. But they've started to do some small buybacks here, down 2%, down 2%. And next we can look at some debt and solvency ratios. We have the debt to equity ratio here, a very healthy 0.1. I mean, barely any debt of any real magnitude. Of course, it has been growing a little bit, but started to pay it down again. Of course, debt was very cheap in this period also, so probably just a good business maneuver for them to increase a little bit of their debt. The current ratio, they can cover their current liabilities with their current assets almost 3 times over, so very healthy also there. So yeah, I mean, there's not really much to say on the key ratios and metrics for Alphabet. There's seems to be a very healthy company, and we can jump into the discounted cash flow analysis next. Here we have a simple discounted cash flow model. We're going to take a look at the assumptions I make and analyze a little bit the rate of return we might expect based on those assumptions. So if we take a look at the valuation metric I use earnings per share, because of course Alphabet is a growth company. It doesn't pay a dividend or anything like that. So the value we're getting is the earnings per share growth. And yeah, we might also use maybe free cash flow here, but I use earnings per share. And the current year, 2022, estimates for earnings per share is around $110 per share, which is in line with the exuberant year of last year, 2021. So it's a little bit of a stall between those years, which I think is relatively normal because there was such a big jump from 2020 to 2021 in earnings. So for the normal case here, we use a growth rate of 14% for the first 5 years, followed up by 9% for the latter 5 years. I expect a discount rate of 15%. 15% is easy to remember because it's a double in 5 years. So if it's fairly valued, the stock should, or the company should double it in value in 5 years. And I use a very conservative 18 PE ratio. The terminal multiple is basically the PE ratio here. It's currently trading at around 22, so we're looking at, another 15-20% downside if it would drop to this terminal multiple. But for those assumptions, the intrinsic value is basically the same as the current stock price, which is around 2,300 now, which is very close to the intrinsic value. So we are expecting a 15% rate of return, which is a double in 5 years. And if we take a look at the best case, I based the growth rates here from I used a couple of resources. I used Yahoo Finance to check out the estimates for the next 5 years growth rate, and I also used the historical growth rate, which is about 17-18% over the past 10 years. So I'm of course assuming a little bit of a slowdown in the next 5 years, and then further in the latter 5 years. For the best case, I use 16% for the first and 12% for the second 5 year period. Same discount rate, of course, and the 22 PE ratio, which is trading currently at. I don't think this is too exuberant. This might well happen. So maybe it's not exactly the best case scenario, but I tried to be a little bit conservative here. So in that case, we have an intrinsic value of $3,072. And if we try to match a discount rate to see what kind of rate we might expect for the best case scenario, if we put 19%, we get really close to the current market valuation. So we might expect 19% per year if the best case scenario plays out. Let's put it back to 15 and take a look at the worst case scenario. In the worst case, I put 8% earnings growth in the first 5 years, 5% in years 6 to 10. Same discount rate, 16 PE ratio, and that brings us to $1,542. And if we try to find the discount rate for the worst case scenario, it's maybe a little bit too high. So yeah, we're looking at around 9% rate of return for the worst case scenario, so still not bad. So our conclusion here is, if we take just some simple probability, 60% for the normal case, 20% best case, 20% normal worst case, we are around the same intrinsic value as the current market valuation. So according to these assumptions, it's very fairly priced for a 15% rate of return. And finally, these discounted cash flow models are always just as good as the assumptions, and reality will always play out differently than the assumptions made. So what we have to do is just continue to make adjustments to the discounted cash flow as we go on, as we get more earnings in, we get more estimates for the following earnings. And of course, this video is also just for entertainment and educational purposes and not financial advice. But I do hope it sparked maybe some interest in company evaluation and just in general some analysis. And yeah, thanks for watching. And if you made it this far, maybe consider liking and subscribing. I don't like to ask for it until the end of the video, so I know you watched it all, so thank you so much for that. And please drop a comment if you have any suggestions for companies that I should do a valuation on. And thank you for watching, and until the next time, bye bye.